We are hoping for one more person who'll be on the panel. We'll see if he comes in as well. Thanks very much. This is obviously a topic that's on a lot of people's minds and very much on your minds as you're in the market. And I see many, many companies looking to raise funding. So let's get started. I have read repeatedly this week, in fact, about 5 minutes ago on my Twitter, that despite Brexit and the general election, that the UK tech scene is definitely receiving more investment. And in 2017 so far, in fintech, we've done more than 2/3 of 2016, something like 769 million. But also, I have seen more investment coming from China, in China, and the EU and the US. So it's kind of a two-part question. One is, has your experience within your own organizations been that more people are coming forward for funding and you're making more investments? Do you think that will continue beyond 2017 for the UK? And the second part of the question is, do you think that Q4 2016, where we had a little bit of a blip, let's call it, in investment in fintech, was a market correction or a response to some of the things that were happening like Power and Lending Club? Want to start, Reese?
Yeah, sure.
Or do you want to start by introducing yourself?
Oh, yeah, so for those of you who don't know me, which is probably everyone, my name is Reese Chowdhury. I'm the founding partner of Parker Lloyd Ventures. We invest into seed-stage companies, particularly within fintech, prop tech, and consumer products. So yeah, to answer your question, what we're finding, so I think last year, you're completely right, particularly from the US, I think fintech funding was down around 13% from a VC perspective. But I find that in the UK, traditionally VC funding has been very much geared towards fintech. So almost 30% of VC funding goes towards fintech style products, or if you compare that to the whole universe of what VCs could fund, that's pretty big in terms of the scale of it. And I think particularly within the UK, we're really well positioned to kind of grow our kind of fintech scene. And, you know, if you look at this morning, two great examples of that. Curve raised a Series A round of 10 million, and Revolt did 53 million round with Index Ventures. So I think, you know, once you've got to a point where you've got something, people are really willing to kind of go there and back you from a VC perspective. I think it's the real challenge is more getting to that point where people are going to really kind of push you. In terms of China and the US, obviously I think China particularly are really trying to make waves in their own way into the European market. If you look at things like Alipay that launched in 2015, and then WePay Chat, which launched just a couple of days ago, they're obviously trying to kind of expand their own kind of foothold where they've got there into our markets, and vice versa. They're looking at potentially our companies. I've seen a lot of Chinese kind of venture capital firms look at us and say, can we take that to China and just increase our valuation 10 times over? Does that answer your question?
It does. And Gonzalo, you are one of the founders of Syndicate Room. You can tell everybody a bit more about that, and then we'll get your reply.
Yeah, sure. So my name is Gonzalo. I'm a co-founder and CEO of Syndicate Room, which is an online equity investment platform. We pioneered what is called the investor-led model, whereby every single funding round on our platform, on Syndicate Room, has to have a lead investor or more than one lead investor, be it a business angel, be it a VC, a family office, which effectively sets the investment terms, the share class, the price per share, the valuation, etc., and commits their own capital. And then it opens up to our online members, who are all high net worth family offices and so on, that can invest money alongside those lead investors, having access to exactly the same opportunities in a fair and transparent manner. So our whole vision is really that it shouldn't really matter whether you are investing £1,000 or £1 million. Everybody should have access to the same opportunities, and eventually, you know, in that on a pound per pound invested, everybody should make or lose the same amount of money. And that's really our vision. That's how we've developed. And we fund companies all the way from idea, all the way up to IPOs on the London Stock Exchange.
A lot of, let's say a third of your portfolio, I think, is in the medtech area. But are you...
Life sciences, yeah.
Life sciences. Are you seeing a surge, as we're seeing in terms of investing in the UK, in your own portfolio? And let's say the proposals, the inbounds in fintech?
Sorry, a surge in life sciences or in fintech?
In fintech.
In fintech. Yeah, we are. I mean, there's a huge interest in around fintech, and there has been for a number of years, for 4 or 5 years. There are some signs that investors are starting to be a little bit more critical around business models and revenue models, or the lack of around fintech, and also fintech companies. I mean, when we launched back in 2013, most of the platforms, most of the fintechs were like, right, we are here, we're going to disrupt banking, and we're going to put banks out of business, right? And then reality hits, and you think, oh, shit, now I need to make money. And suddenly, when you have to make money to pay the bills, you think, actually, partnering with banks could be quite a good way of doing it. And then the revenue model reality hits, and the conversation became a lot more around collaboration with banks and other financial services companies, which, by the way, I've always said that's the right way to go around it. The problem is that with financial services, and particularly the biggest of them all, the lead times are 18 months, 24 months. And most of these companies don't have money to run for more than 12 months. So there's a tiny gap there of 6 to 12 months with no money. And that has hit investors in terms of looking at fintech and be more selective. But the interest is still there, and I think it's a very healthy interest. And to be honest, I think it's quite healthy that investors are much more careful about their investments in fintech. But certainly still there, no doubt about it.
I think that partly answers the question about Q4 2016 as well. I think it was, we had the FOMO, the fear of missing out in 2014. I can remember myself, if I had companies looking for money, if I opened my jacket and went, psst, I have a fintech looking for money, everyone would have thrown money at me so that they didn't miss out on this thing. But we had potentially inflated valuations and people not delivering, or companies not delivering on their promised land. And we'll come back to what you're looking for in the model as well. I wanted to ask you both, we talked about that early stage, so that seed, you're in a seed investor, and you see them in the post-seed potentially. The seed rounds have got much longer, generally speaking, right? And the Series A are bigger now. I think even last year they were averaging 3 million. That's probably gone up again. Something that filled the gap, which I think you may have both accessed, were the accelerators, which went from one fintech accelerator in 2014 to having, generally speaking, over 265 accelerators in the UK, I think, at the moment, in one flavor or another, whether that's IoT or medtech or fintech. So, again, at the same time, we're seeing this model having to evolve. Long live the accelerator is dead, and having to evolve in this space. Have either of you done any kind of scouting in the fintech accelerator space? What are your thoughts on it, and do you think you came out with some good prospects from it? Reece?
Yeah, so I think I have mixed emotions about accelerators and incubators. I think the thing is with, there's some really good ones. And there's some, I'm not going to mention any names now, but there's some really poor ones as well. And I think what we found is they're a good way to access companies at an early stage, don't get me wrong, because they kind of provide the structure. You're there. For us, obviously you meet 10 companies in one go, and there might be one gem. But I think with fintech, some of them, I think, are a little bit light in some really core areas we find. So particularly around, sorry. Oh.
Apologies.
We thought you didn't love us anymore.
Still love you guys. A little bit late.
So what I was saying is basically I think they're a bit light in their support in particular areas, particularly around regulation. So the ones we've looked at a lot are particularly within, we focus particularly on the peer-to-peer space. And so, I think some of them don't really have a full understanding of, how you would get like a peer-to-peer full FCA license, and the challenge you would have to do to that. I think there's a publication out there saying you're going to need to spend £2 million to get a full peer-to-peer FCA license. Well, if you told that at the start of your accelerator, you wouldn't go down that process. You would, obviously look for other avenues potentially, or look for different things. But I think just an awareness of an all-round package is needed more if you're going to market yourself. And I think some people look at it as just a money-making spinner. rather than helping the kind of entrepreneurs. So we particularly like looking at universities that are non-profit, that are helping ideas come out from their students, who are genuinely there to help people rather than just kind of make $2,000 a month of each company, which some of them basically do.
Gonzalo?
Yeah, I mean, some of the accelerators are absolutely fantastic. They really are. Most of them are not worth the time at all. Right, as simple as that. The top tier ones, you know, it's almost like a no-brainer if you're at that stage as a company and you get accepted. Is a no-brainer. And we've worked certainly with quite a few of the, well, pretty much every single one of the top tier ones, and we've actually found plenty of really good companies in founded. I think the last one we founded from an accelerator was Quirrell, which is a fintech company from Wayra. And you know, it's an incredibly exciting company with a phenomenal entrepreneur that is really like passionate about it. And so those are the type of accelerators we definitely look at. Some others, my concern is that some of the companies are told, well, because you've been on accelerator, your valuation should be at least X amount. And then there's a complete mismatch when investors go, well, don't even think about it. And they go, well, but the accelerator told us that we were worth that much. And then you get into that problem that is caused, and unfortunately, the main losers, they are the companies and the entrepreneurs, which is the big shame from where I stand.
Very interesting perspectives on them because they became much more popular. Martin, I let catch your breath there. Thank you for joining us.
Once again, my apologies.
It's okay. You can introduce yourself to the wider audience.
Martin de Wever, I'm the CEO of Force Overmars Capital. Recently, we also started a technology arm actually in there. So we do a little bit of both. We're VCs and we're also a fintech company ourselves. So hopefully I can give a perspective from both angles actually today.
Fantastic, thank you. So now that we've established that there is a market and we're increasing investment and we think that's going to continue, what do we think that the, say, new hot verticals or the couple of hot verticals will be in the next 3 years now that we've potentially seen payments, lending, remittances, all the early stage fintechs maybe cooling down a little bit for something else might be more exciting or different coming up? Reese, what do you think is coming up?
So I think what we're seeing is we've had a lot of companies, particularly in kind of the, I would say, wealth management of yourself or other companies. So you know, we'll look at your bank statements and see how we can kind of save you money on a B2C scale. I think also what we're seeing is coming through is potentially on a B2B level, which I don't think I've seen many people kind of crack really well at the moment. You know, going into a company saying, look, you know, you have 10 Netflix accounts, you could have one, blah, 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 that kind of level of kind of intelligence, as it were. So I think that particular sector, I think, is growing well. There's lots of good companies. We had another company that's just done a deal with Monza, who came to pitch us a couple of weeks ago, we really thought was really clever. So I think, you know, I still think, go back to the payments and stuff, I still think there's a lot of maturity to come in those markets as well. I think me and Gonzalo were just talking about the business before, and you know how things like Syndicate Room and you know the peer-to-peer lending space in general is just scratching the surface. And I think it's more of fact there might not be hot verticals like Bitcoin or whatever, but it's just a maturity of the verticals that were seen to be hot a couple of years ago.
Martin, can we get your input there? What do you think are going to be the hot verticals?
Yeah, I think you're actually giving a good point actually when it comes to blockchain. And we started looking at blockchain for several years now, and I agree actually that in the beginning there were more like glorified consultants on the blockchain matter, and now you're actually seeing proper application actually of blockchain technology into finance space. So yeah, it's good to see that it become more investable opportunities instead of just a dream stage. But away from that, you know, there are many different niche markets within the finance space where you need bespoke solutions. But niche markets in finance world are actually huge markets on its own. So it it can be when it comes to finance, shipping, for instance, something just for the receipts. I think you mentioned probably the same company that we have invested in. To more a more detailed proposition than when it started years back with challenger banks, which was the whole encompassing. Let's look at banking as a whole and try to reinvent the whole concept. Now it gets more to real applications to make life a lot easier for people working in the finance industry or for particular verticals, and completely reorganize a smaller portion of that. So yeah.
That's all the way. People speak about reg tech, obviously wealth, and AI as 3 areas. And I know we have some AI companies in the room today as well. Will these be the next areas that get turned on their head?
The way we've looked at it is not so much by such like specific definition of verticals. It's much more about the underlying behavior behind it, in the sense that anything that changes behavior or requires the user to change behavior in financial services is like a really, really steep uphill struggle. Anything that doesn't require the user to change their normal behavior or makes it a lot easier, makes it no behavior at all, like potentially wealth management, as you're talking in robot advisory, then that makes it a lot more interesting. So it's not so much, we don't see it really as just specific verticals. If you really want verticals, I think every single vertical is a huge opportunity as long as you get it right. There are some pitfalls, and depending, if it's B2B and selling financial services, the lead times are horrendously long, as I mentioned. If it is a Me Too business, chances are you're coming in too late. If it's another wealth management sort of robot advisory, there are tons of them out there. I'm sure there will be a new one that will be successful, but then the likelihood of you investing in the right one goes down and down and down. Same thing for peer-to-peer lending. There are some very successful players out there. How are you going to outcompete those? It's pretty tough right now.
I think maybe we'll see some consolidation and some of the stronger partners maybe also coming to the fore. We've touched on this a couple of times in terms of the type of the model, the B2B versus the B2C. And in our previous conversations, I know we've discussed this. When we will talk about what you're looking for, what makes a company investable for you. But one thing that I'm listening and hearing you say, are we looking for companies, or are you looking for companies that get to a positive cash flow position much more quickly than we might have been looking prior to Q4 2016? Martin?
Absolutely. I think the VC model has completely changed. I think 3 or 4 years back, people were still looking at user growth and thinking, okay, making money is something for later concern. It's much more about giving more clarity to your investor base, and that means that cash flows get pushed actually to the forefront when it comes to making investment decisions. So, even the early stage companies, when they're literally in that seed stage, we need to have a good idea of where the cash flows are going to come from, and if that hasn't been clarified in their head, there is a potential risk there. So, we've always been focused more on B2B types of businesses, and if we go into that consumer space, we've always liked the B2B2C model. You use the strength actually of another company to do the distribution to the consumer, as that scales really well, and that works really well from that cash flow perspective. And then you already mentioned earlier another interesting point to note is that, yes, onboarding times actually with financial institutions are very lengthy, but the retention rate is so high. So as an investor, once you actually manage to actually onboard large corporations, and that B of the B2B, then you get into a stream of a recurring cash flow. And that is obviously what we like as an investor.
I think yesterday I said to you I was doing a presentation on scaling up and scale-up funding, and I was sitting with a lot of people that were just starting out who hadn't raised their seed round. When we talk about venture capital, we are generally talking about the fact that you've kind of got a model now that you need to go on and prove is scalable and will generate profitable business as you move along. And I think combined perhaps with some of the things that happened in terms of some business not going exactly to plan, we've had a bit of a retrench and now going back to. So are you looking for unicorns, zebras, donkeys, rabbits, any other animal in the forest that might actually be a real business that moves forward? Gonzalo?
Yeah, we're looking for lions that they don't, they they don't put that much effort into it, and yet they get the vast majority of the meal somehow. We're looking for, so unicorns are great if you can get one, but they are very, very hard to be part of. And yes, they are by far the most talked about in the media, but actually, you have just a few. I was looking at the graphs just on the way here by Business Insider today, which shows the number of unicorns in different countries in Europe. And Sweden does particularly well. So does the UK. But even then, we're talking about each country having less than 10 of them in total, right? And then all the other countries, they either have none or one or two. And you think about the hundreds and thousands of companies being invested in, makes it very low likelihood of hitting it. So really what we want is a sustainable business. Unlike you, Martin, we don't actually require like cash flow or anything like that. I mean, we're big investors in life sciences, and the business plan doesn't even incorporate any revenue whatsoever. You get to phase 3, you prove the drug, you sell it for a ridiculous sum to a large pharma company, and that's absolutely fine as long as it's part of the plan and as long as the investors know that it's coming and they're expecting it. But it's really about what can be 10 times better than what's out there, what can be sustainable, and above all, can the team do it? And particularly on the VC side, where there's a huge transition between the startup stage and designing a new product and understanding the clients and so on, to actually hiring far more people, starting to deal with people and with difficult people and the team, and growing the team and keeping them all very motivated throughout the entire journey.
That actually raises a good point, and we can move on to that magical question that everyone asks. What makes me investable? What are you looking for? What do I have to do to get money out of you, Reese?
That's a great question. So we see a lot, we see probably about 15 pitches a week. So we see some really good ones and we see some really bad ones. I think the key thing, so we break our kind of due diligence process into kind of 3 or 4 stages. First, we kind of would meet you at something like this or something, and you might send us your pitch. We would actually just have a look at what we did a lot of research into this idea kind of execution kind of model. So we found that with entrepreneurs, it doesn't really matter if your idea is amazing. I mean, I think Zopa is a really good example of that. Lending money to you has been around for hundreds and hundreds and hundreds of years, but they just executed it amazingly, and they're $1 billion company. So I think we always look at that first, and then we kind of go through a screen which we've developed through companies that we've invested in that's gone on to do good things. The main thing I would say, I'm going to shut up now, is definitely the main focus we have is on founders. All our process is focused on founders and how they react to situations and what they would do and how good their team is. So we give situational questions like, when your back's against the wall, you're burning through cash, you've got 1 month to do, what would you do in that situation? Just to really push them and to see what their kind of mentality and thinking are. Because in startups, it's a hard world. I think you have no idea. One of the companies we invested in, the guy took no salary for 2 years, sat in his bedroom and basically wrote an FCA application by himself. Right, with no money. So I think, that's the kind of reality of this world. It's not all, Mark Zuckerberg on, Harvard lawn just typing away and making $1 billion company. It's just not like that. So I think people need to really realize that and obviously get your pitch deck right. But
Thank you very much. Martin, you're looking at the slightly later stage, as Gonzalo mentioned, that the teams change a little bit and the businesses change a bit as they move on. So what are you looking for when you make an investment?
We actually, we actually do both, right? So we do seed stage, very early stage, pre-revenue businesses, but now we're moving as well with a separate fund into that later stage segment. And your criteria actually for selection completely changes through the life cycle of the company, which is quite logical. So in the beginning stages, it's all about that founder. It's all about how he can create a synergetic team around him. Over the last several years, we've gathered quite a lot of data, but more qualitative data on, what are the DNA characteristics of a founder, and what should we be looking at? How can we train that pattern recognition of what makes a true entrepreneur? And interestingly enough, actually, in that, it's all about perseverance. As long as somebody keeps pushing forward, that is the person you want to back. You want to back the person that never gives up. That is the main reason why people actually shut down their company, is because they're going through a rough patch, like everybody is going through, and they think, okay, I can't do it anymore. So that is what you want to look for, actually, for investing. Obviously, they need to have some level of intelligence, actually, to pull it all off, and the idea is almost secondary, because if you get the right jockey in place, he can come up with anything. Yeah.
So we're back to the A team, potentially with the B product is still okay, and with an idea that has legs. I'd like to ask you guys, venture capital globally, we only see 10% of the money going to women. And you all know me well enough to know that I'm not a kind of stand on the soapbox and, or bang the drum about this. But it is slightly disturbing, and the language that women, well, actually everyone in a venture capital interaction, there's been some studies done recently where if you have a preventative question asked to you, as in preventing loss, versus something that's more proactive, making profit, 67% to men proactive, 66% to women preventative. That was what the study found. If you answer according to those questions, that's the outcome that you get 85% of the time. It's a little bit of a self-fulfilling prophecy. If you answer the questions not in a preventative way, not in a safety kind of loss prevention way, you have a better outcome. There's been a lot of talk about women not wanting to approach venture capital or to go forward because they don't either feel comfortable or they don't feel confident or they think they're not going to get the money. Are you seeing more women coming forward, Gonzalo?
Yeah, we are. I mean, one of my main criticisms in the VC world is that it's just absolutely full of white middle-aged men, right? And that makes it really hard to get the variety of backgrounds that you really need, be it women, being it of other races, be it of other countries, be it of foreign languages, be it whatever. And that, to me, that's one of the main barriers for people with different backgrounds to get funded. One of the beautiful things about Syndicate Room and any other online platform is that it removes, to a certain extent, that level of interaction. And you look at our team is incredibly unusual in financial services because just over half of it is women, right? And in financial services, that is absolutely unheard of. And the amount of lateral thinking that comes in with it, and how the whole team within Syndicate Room interacts, it's so much better as a result of being just over half women, but also nearly half of all over the world.
I think it's been proven that the bottom line improves by 20% with the mixed team. I see that I'm getting the sign, so I have one question.
Can I just answer the women question, just because we've done a lot of work with that?
Oh, have you?
Yeah, sorry, just to elaborate. I think, Gonzalo is completely right, diversity of thinking. I think we looked into this a lot because we found it a real problem, and we're really passionate about it. And basically, a company that's started up by a woman is 50% less funded, right? And the reason why is because there's 3 men on this panel, right?
Look who's controlling it.
And if you look, yeah, obviously in the VC space, and I think if you look at some of the big funds, the FT did a study on this, and they looked at some of the big funds I mentioned today. Not one of their partners was women, right? And so I think we need to change our side of the world a lot more. I think that we really need to look at ourselves a lot more. Anyway,
I think we could have a whole day on this.
Yeah.
So as a final parting question, not everyone agrees with this, but most would say that London has been the fintech capital of the world. I realize I'm throwing a cat amongst the pigeons there. In a post-Brexit environment, what is the one thing that you would say to the UK government to do to make sure that we retain this position?
Allow talent in the country.
Talent, okay. Reese?
talent as well, absolutely.
Martin?
I'm a little bit worried actually when we leave the single market, coming originally from a banking side. we could see a little bit of a brain drain. So I'm hoping that that doesn't happen. It also means a lot of things for us, for licensing and etc. But indeed, yeah, we need. I don't think it's going to change overnight. So, but retaining the right people, the right mix that we have, we're so lucky to have over here. This is the finance capital of the world, and therefore we are fintech capital of the world. Yeah, there's a huge risk of losing out to New York, for instance, and other places.
Thank you. So if anyone's tweeting or anyone in government or treasury is listening, release some more of those visas.
Digital skills visas, right? That's what they're looking at. Yeah, get that done.
Thank you all very much. I don't know if we have time. No, we don't. We don't have time for questions from the audience. We'll have to do that over coffee or drinks. Gonzalo, Reece, Martin, thank you very much.
Thanks,
Thank you.